which we're currently covering is Tribhuvan Das Bhimji Zaveri, that's TVZ. Operationally, it turned out to be a weak set of earnings for them in Q4 with revenue growth just up close to about 4%. The stock, however, is holding up with gains of about 2% because the profits were higher by 58%. To talk more about the company's numbers, Prem Hinduja, the CFO of the company, joins us on the phone line. Afternoon, Mr. Hinduja, and thanks so much for joining in. It does appear that the jewelry business is under some pressure. You know, your revenue growth is only 4% this quarter, much lower than, the 18% that you had in the prior quarter and, 32% revenue growth that you saw in Q2. We understand that those were seasonally strong quarters, but even then, a 4% revenue growth seems a bit sluggish. What's the outlook on the growth front for FY16?
The outlook seems to be pretty strong because we have seen that most of the headwinds which were there previously have now removed or they are withering away. Like in terms of the demand we are seeing is reviving, and plus the government conditions in case of basically gold loan scheme has been revived, the 80-20 scheme has been revived, has been cancelled, and basically the consumer sentiment, the discretionary portion of the consumer sentiment is improving. There is a drop in inflation, drop in oil prices, and the company is also making its own efforts through its own innovative designs, new diamond collections, gold jewelry collections. So going forward, we are seeing that the headwinds withering away and the tailwinds gathering momentum, which will help us in reviving the demand. So we see that although our Q-on-Q sales growth is only 4%, but our profit growth is 58%. From 11.7 crores to 18.49 crores for this quarter as compared to the previous corresponding quarter. And going forward, we are very confident that things in the next year will gel out quite well. The company has also taken a lot of its own initiatives in terms of new designs, new collections, and plus it is also on the growth trajectory for the next few years.
That's true, sir, but even your bottom line does have an exceptional gain of about 8.7 odd crores. But nevertheless, on your EBITDA margins, you've done about 5.4% this time around, which is better than the 3 to 4% range that, we've been seeing for the last 3 quarters. But even till a year ago, you were doing upwards of 7%. When might one see, the return of the high single digits in terms of your margins?
I would say given the next 2 quarters, end of next 2 quarters, I think the second half of next year, fiscal 16, should see us reaching that level. Because, as I was mentioning, the demand is reviving. Earlier there was pressure on the margins because we had to do some bit of discounting, tactical discounting to attract the customers, which over quarter on quarter is going on reducing. And as we see the demand revival and all the tailwinds gathering momentum, we are quite hopeful of reaching that level, maybe in the second half, that means the third quarter of fiscal 16 onwards.
So you're saying in H2 of FY16's margins would be 7 to 8% or even higher?
It could be at least that much, but it could be even higher. And we are making all out efforts to do that, but even focusing on new collections and all that, which give us a higher margin.
What are the company's targets with respect to store expansion in FY16 and the CAPEX?
The company's target is basically we have taken a next 3-year business plan where we are planning to grow about 60% from the present retail space of about 91,000 square feet. So which means around approximately on an average about 20,000 square feet or about 25% will be added every year for the next 3 years. So that is the company's target. But there is a slight change in the model that so far the company had only company owned and managed stores. So going forward it will be a combination of franchisee stores and company owned stores. Franchisee stores because that is an asset light model where the inventory will lie on the books on the franchisee and it will help us grow faster without putting much pressure on the working capital of the company.
So, the making charges on plain gold jewelry have gone down to 8% now from the 12% earlier. Some of your peers are also, to aggressively target customers are sort of cutting down the price premium on plain gold jewelry. Could there be a change in strategy in store for you as well? Is that something you might consider?
Not really, because basically, I think these peers, I would not like to comment about why they are doing that, but they are selling it more as yellow gold. but we focus on design, So when design comes into the picture, and of course in addition to that the customer service we render and the strong brand image we have, I think we are not in favor of following that path. We will maintain our path, what we are doing at present, attract our customers with our unique collections and better designs, and I am pretty confident that will not force us to put any pressure on our margins by higher discounting.
Okay, your net debt went up by about 55 crore in FY15, and I think it currently stands at about 550 crore. Any plans, for the company to reduce their debt or raise some equities, because you do have, some capex also which you've outlined for the next 3 years?
Basically, there was a reason for the slight increase in debt, and the reason was, first of all, let me clarify that portion you are talking about is also including the gold metal loan, So more than 50, half of it is gold metal loan. So if I include this gold metal loan, my current debt to equity ratio is about 1.2:1. But after removing the gold metal loan, it is just 0.6:1. But all said and done, we had earlier that KP, our advance installment scheme, which was stopped by the new Companies Act. And thereby last year when there was a lot of redemptions which have taken place, which put pressure on the working capital. But now this year we have revised that plan in the new avatar, taking into account all the new regulations and requirements, and we are hopeful that will also give us impetus, lot of cash inflow plus additional business which will come by that, and thereby which will keep on reducing the pressure on working capital and bring our debt levels to a comfortable level as which we had done earlier.
So in 3 years, you gave us your retail space, how much you would like to grow the business. What about on the net debt? Have you come out with an internal target?
See, as I mentioned, that predominantly of the growth will be in the form of a franchisee, where the inventory will be on the books of the franchisee. So basically the addition to our capex will not be there because all the expenditure will be taken care of by the franchisee. So the pressure on our case will be very, very minimal, which can be taken care of by the internal accruals of the company, which the company will have in the next 3 years. So I don't really foresee that the company may have to tap the equity market or to add to the debt to take care of this growth or expansion.
All right, Mr. Hinduja, we'll leave it at that. All the very best for FY16. Thanks for speaking with us. So that's the word coming in from TPZ. Regulatory headwinds are reducing for the industry. The second half of FY16 is when we can see margins in high single digits, as well as a big aggressive plan to actually expand via the asset-light franchisee model.